Well, I've been expecting both financial stocks and interest rates to rally in the first part and into the second part of this year. And after a correction in January and early February, that's precisely what we're beginning to see. We see that 10-year yields had a double bottom at the 2.6% area, and I believe they're heading back to and through the 3% level. We've also seen key financial stocks, those in the credit card sector, discount brokerage, and so on, begin to rally again after the pullback based on some fear over the emerging market turmoil we were seeing in the Ukraine, in Argentina, Turkey, and elsewhere. So again, I think as interest rates head up, particularly the spread, the difference between short-term interest rates and long-term interest rates widens, I think you'll see, again, both interest rates rally and financial stocks rally as profitability goes up and growth opportunities pick up. If we look at the interest rate trends over the much longer term, we can see clearly that they peaked at double-digit levels in the early 1980s, and this was followed by a 3-decade-plus bear market in yields or bull market in bonds, and bond prices go in opposite direction of bond interest rates. We've seen that as of spring 2013, rates have turned sharply higher from around 1.6% on the 10-year yield to around 2.7% right now. I believe, again, that we're going to be heading through 3% on our way to at least 4% in the next intermediate phase term of this move. And that, again, underscores we've seen a 3-decade bull market in bonds and bear market in interest rates reverse. And now we have the opposite. We have a bull market in interest rates where you want to essentially buy pullbacks, in other words, get ready for higher rates, and a bear market in bond prices where you want to sell your long-term bonds anytime that prices rally. Again, when you look at the financial sector and the financial industry, as interest rates go up, some of these names will actually benefit. You have discount brokers that have had to waive money market fund management fees because interest rates have been pegged to the floor. As interest rates go up, they'll be able to make some money from managing those funds again. They won't have to waive those fees, and those fees will therefore flow right to their bottom line, boosting profitability. You also have some banks that have been hurt by the Fed sitting on the long end of the curve, basically holding down long-term interest rates versus the level of short-term interest rates. Well, as the Fed dials back on quantitative easing, or QE, long-term interest rates are going to be allowed to find their normal equilibrium level, which is going to restore profitability for many core banks that aren't involved in these fancy derivatives and other risky areas of the market. You will see revenue from things like mortgage lending go down, so you wouldn't want to be overexposed to that sector. But discount brokers, some of the traditional brokers, some of the credit card names, and some of the exchange operators that benefit from rising interest rates and rising volatility are all potentially attractive places to invest money as interest rates go up.